Yep, we can see it.
All right, very good. Thanks so much for having me. Thank you so much, guys, for tuning in here today. Very honored to be here. Actually on the go right now. I'm out in Houston, going to a conference here tomorrow, multifamily conference. I'll give you guys just a real quick background scoop on myself. Daniel did the great intro there, but just to kind of paint that picture a little more vividly. So I did get started in 2009 with real estate investing. It was at first in the single family space, the way that probably a lot of people get started in real estate. So it was just, in my own backyard. Did everything from house hacking, renting out spare bedrooms, fix and flipping homes, vacation rentals, and I had some buy and holds. And what's important to point out about this time frame from 2009 to 2015 is that I was trying to build up the single family portfolio that I was self-managing on top of having a full-time career in the oil business. And I was working 98-hour work weeks, often away from home, and then later overseas, where I was gone for months at a time on occasion. And the fact of the matter is, it was way too hard to scale a single family business in my position. And what I found by networking in a lot more groups and a lot more conferences is that a lot of people are kind of feeling the same. As you get to 8, 9 properties, somewhere in that ballpark, it tends to get very labor intensive. Even if that's not hands-on, it's still, even with a property manager, that can be kind of a full-time gig. And so that was kind of my experience. Around 2015, I kind of went back to the drawing board. I started networking a whole lot more, found a few mentors, and this is where I learned about apartment syndications. As Daniel pointed out, that is the pooling of capital together with numerous investors to purchase larger assets like an apartment community, as you can see on your screen there. That's an example of a Ashcroft Capital project. And basically, we share in the cash flow and any potential equity upside while being 100% passive in the investing approach. So, it doesn't matter if you have one investment or 1,000. This is a way to participate in real estate while being hands-off and being able to have a scalable model to work from as you focus your full-time attention on your career. It was probably a little more than 60-second background, but that's basically where we're coming from. So also, as Daniel pointed out, I am Director of Investor Relations at Ashcroft Capital. I am, at the end of the day, quite honestly, I'm just a full-time limited partner investor in apartment syndications. That's about 80 to 90% of what I do is just passively invest in what I'm going to show you guys here today. The other 10% is just spent on, networking events, and I do some speaking panels, and, you might run into me at a multifamily conference if that's the type of thing you go to. You might see me at like an Ashcroft Capital booth. I invest heavily with this group. Been investing with them about 4 years now. I'm in 9 of their deals personally. I've got a lot of my family and friends in these deals as well. And so I'm just very passionate about kind of the model that they have, what they do. And as Daniel pointed out, they're one of the big players in this space, about to pass about $1 billion of apartments here this year. So without further ado, a couple just disclosures. This is educational purposes only. This is not any form of sales pitch. This is not an offer to buy, solicit, anything like that. I'm just going to run through kind of, what this is all about, why I choose to invest in it, and help answer any questions that you guys have at the end. I don't intend on taking the full hour here. I'll take, as long as it takes to get through this without being too short with it, and then hopefully have some Q&A here at the end. And also, one more disclosure I think we're supposed to point out, it's not the views or opinions of Intel either. All right. So why passive income and why syndications specifically? The number one reason for me and my own story and my own experience is that there's no active management. That can be a very huge thing. It may not be a big deal as you have one or two rental properties, but as you start scaling that up and as your wealth expands, you quickly realize, even with a property manager, that, hey, this isn't really passive income in the traditional path. Number two, we'll talk about a little bit more later in the presentation, but diversification among income streams. There's a great quote that I'll cover here in just a minute. Number three, this is an uncorrelated asset type to the stock market. Yes, it does have its cycles, and yes, it is indirectly affected by the ups and downs of the economy. However, for the most part, it doesn't act as maybe like a REIT, which is a real estate investment trust that you would invest in on the stock market, where, you know, some guru comes on TV on CNBC and says the sky's falling, and then tomorrow you lose 20% in your portfolio. These are very uncorrelated to that type of volatility. And fourth, as I pointed out earlier, this is a 100% passive approach to investing in real estate. All right. So here's the quote by Warren Buffett. Never depend on single income. Make investments to create a second source. So I like a quote that is very similar to that by myself here. Never depend on single income, but make investments to create multiple sources. So I'm a huge advocate for diversification. That's diversification in so many ways among income streams and geographic locations and different sponsors and groups. I don't solely invest with Ashcroft Capital. I invest with many different groups. As Daniel alluded to earlier, it's somewhere in the ballpark of 14 different operators and growing. So, multifamily investment. Let's talk a little bit about recession-resistant investment. So multifamily is a big term, and it can mean a lot of things, and there's a lot of different strategies, but it's not all created equal. So Ashcroft Capital and myself personally, we invest in mostly B-class apartments, which are commonly 1980s, 1990s used product that has either had some deferred maintenance issues, potentially some bad management, or, you know, there could be a million different reasons, but we're picking up some deals that need some help, and we're going in and we're fixing the problems, and we're adding value. So they're value add B-class and sometimes C-class deals, and then we're bringing the rents up to the market rate. And at the end of the day, this is workforce housing. This is middle income housing. This is affordable housing. You can coin any term you want, but it's highly in demand, both from a tenant perspective and from a buying and a selling perspective right now. Low volatility, we talked about already as compared to maybe a REIT or the stock market in general. More predictability of income, cash flow. We can often see when we're buying these properties what the numbers were in 2008, 2009, 2010. How did this perform comparative to other asset classes? The short answer to that, getting all analytical, it performs exceptionally well, both in recessions and in good economies. So there's a lot more predictability versus doing some speculative new development, new construction, saying, hey, we're going to start building something from the ground up. 5 years later, we hope the price is going to be whatever. Okay. Talked about this a little bit, but it's a very scalable investment model, whether you have one investment or 100. This is hands off. Once you kind of do your initial due diligence on a deal, decide you want to participate, send in funds for the deal. That's it. You sit back, collect the paychecks, and then when it sells, you get your money back plus whatever equity there is there. Economy of scale. This was really a big epiphany that I had when I had single family homes. And that's that, you know, when you have a handful of homes and you've got to go buy fire alarms, fire extinguishers, you know, when you're talking about the roofs or the HVAC systems, every house has its own whatever we're talking about here, rather than having, say, 100 units under one roof, or being able to place a purchase of 100 refrigerators or 300 refrigerators, more commonly in Ashcroft's situation, versus one. There's a lot of economy of scale benefits. A lot of the markets that Ashcroft invests in, they own multiple apartment complexes, just either next door, across the street, or a couple miles away, so they can kind of interchange the staff and the maintenance as needed. Rather than hiring 3 maintenance professionals, they can hire 1, and that guy or gal can just bounce around back and forth between the properties. There's a lot of efficiencies built in to multifamily specific to syndications. Also, you can use a self-directed IRA to invest in multifamily syndications. So that's kind of its own topic. Happy to answer any questions on that. I've had self-directeds. I work with people all day, every day that have self-directeds. So if that's something of interest, we can look into it. Basically, most 401ks and IRAs are held with like a TD Ameritrade or Charles Schwab or Fidelity Investments or something like this. And, they don't allow you to participate in these private placement syndications. So it would be basically moving custodians from a group like those mentioned to an independent self-directed IRA custodian, and now you have the ability to invest in physical gold and silver, oil, gas, businesses, LLCs, and real estate directly. So again, a topic I could go an hour on, but we'll leave that for later if you guys have any questions. And the one I highlight here, everybody's always asking about the tax benefits when it comes to syndications. I think everyone knows that real estate holds some amazing tax benefits, but how exactly does that work with a syndication? What I did on this next slide is, this is actually my own K1 with a deal that I invested in with Ashcroft, just to show you guys. This was a deal that closed in, I think it was like November 2018. I had put $50,000 in. You can see that on the right side of your screen. That was my investment. And what you get is a K1 partnership tax form delivered by March 31st of the following year of any investments that you make. And they've already done all the heavy lifting and the work for you. They do things like cost segregation, and they, capture the bonus depreciation and all the tax advantages that any other type of real estate would hold, but they're maximizing that. Again, back to the economy of scale and efficiencies of multifamily and syndications, you're able to capture a lot of great benefits, and it flows through to you and I as the passive investors. So what you're seeing there circled is, on paper, because of depreciation and cost seg, I'm showing a almost negative $16,000 that I get to basically write off. It goes against my taxable income off a $50,000 investment. So you can kind of run the numbers in your head there. That's just one example in one deal. Every deal is a little different. Some are even more advantageous than this particular one, but you get the idea. Not to segue again, a whole nother topic. I'm not a CPA or tax professional, so seek your own advice here. But you can become what's called a real estate professional. There is some criteria you need to meet in order to qualify in the eyes of the IRS. But you can actually take these losses against active income if you are deemed a real estate professional, or your spouse is deemed a real estate professional. You can also benefit from that even as a W-2 employee. This is how some of the high-level bigwigs out there in real estate, like a Robert Kiyosaki or Donald Trump, always, they don't pay tax, legally, and it's because of real estate depreciation and tax advantages like this. They've got so much invested that it offsets all of their income. So just wanted to highlight that quickly. Again, we can talk more in depth, but at the end of the day, I'm not a tax professional, but I can point you in the right direction. All right. Next thing here, I want to just briefly touch on. I don't have a lot of analytics on this. This is just a pretty high level, presentation that I'm running off of here. But increasing number of renters, just an interesting little graph here on the left by the U.S. Census data by Rent Cafe. So this was just a snapshot of 2009 to 2015. This is far expanded from 2015 to 20. I just couldn't find a really good graph to show it. But on the far right there are folks over 55. So your baby boomers are, renting in the masses. You can see there on the left, that's about 2.5 million increase in renters. In the middle is kind of your Gen X, if you will, and then you've got your millennials there, which is far expanded from where it was on that graph from 2015 to 2020. But the fact of the matter is, a lot of people are choosing to rent. There's a number of reasons for it, but it's turning into more of like a lifestyle choice, more so than a necessity. I mean, affordable housing is definitely a crisis, don't get me wrong, but folks like even myself choose to rent out of lifestyle. Live in a beautiful place, my wife and I, downtown area, high-end amenities. It's just a really great, flexible lifestyle, and if we need to get up and move tomorrow, we do it. And the most hit that we take is maybe forfeiting a damage deposit, and not being underwater in a home in the middle of a recession. So just something to keep in mind. This is definitely an asset class that has gotten a lot of attention here in recent years. So I do want to definitely talk about risk. That's one of the most important topics when we come to investing and in real estate, and questions that a lot of people ask. So what are your main areas of risk when it comes to syndication investing? Well, number one focus of Ashcroft Capital, and in my opinion as well, just as a limited partner investor, is your preservation of capital, right? Who cares if you made 10% this year and 20% next year and then you lost your principal? That's zero, in my mind. So it's always focused around preserving your initial investment that you put in. So how do you do that? Well, Ashcroft and myself, independently, we look for, or rather we focus on cash flow, not appreciation. Yes, they underwrite for future appreciation and targeted, exit points upon sale. However, everything Ashcroft is buying is stabilized, meaning 90% occupied for more than 90 days. And, it's workforce housing that's cash flowing day one. So everything they're buying, they're just going in, they're rebranding, they're switching out property management, they're starting to increase the curb appeal in the landscaping, going in and renovating the units and fencing in the ground level yards and adding covered carports and sometimes self-storage on site and things like Amazon lockers or package lockers for the tenants. And so they're making the community a better place, a safer place, a more efficient place, using green initiatives, more eco-friendly, LED lighting and water efficient toilets. All this kind of stuff is the type of value add that we do so that we can incrementally bring the rents from where they are upon purchase to the current market level, or in most cases slightly below market level, just to stay competitive. But cash flow is the name of the game. All right. Number two, we secure long-term conservative financing. And I need to clarify this because long-term gets different perceptions. What we're talking about here is if we have a 5-year business plan, meaning that we're all going to invest together, we're going to renovate the units, do everything I just spoke about, and then we're going to sell within 5 years, then we're going to put a debt structure or a loan that's at least twice as long as the business plan to give us a little bit of wiggle room in case we do go into a recession, or in case something does go wrong, or in case we need that added flexibility. Most of the multifamily that was lost or went into default or got handed back to the bank in 08, 09, 2010 was because they didn't have a long-term debt structure. In other words, they were forced to either refinance and they couldn't because they were underwater, or they had to, obtain long-term financing in the worst time possible, and so there just wasn't a viable option for it And so those are some of the things that can get you into hot water with syndication. So you need to make sure that there's an adequate debt structure, not a short-term bridge loan, not some temporary 12-month note, and then we're going to try to refi or sell. You want something longer term. Number 3 is just having adequate cash reserves. Can't speak enough about that. I've been in syndications with some other groups where they didn't have a capital expenditure budget planned in the beginning, which, hey, I could say that was my fault for not really reading through all that documentation. But what happened was they had, I think in this particular case, they had a fire on the property. And even though the fire and the damage was going to be covered by the insurance, and eventually was, what it caused is a lot of upfront costs that, basically the partnership had to pay out of zero in reserves. And so what they did is they stopped distributing cash flow distributions to help pay for, that unexpected event. So you definitely want to work with a group that, they will raise the capital expenditures budget upon closing, and you want to make sure that that's going to be enough for all the unexpecteds that could go wrong over the next several years. Ashcroft does a great job at doing that. Another reason I keep investing with them. All right, let's talk a little bit about strategy. I'm sure you guys recognize this guy, Robert Kiyosaki, author of Rich Dad Poor Dad and the Rich Dad Company. The reason I bring him up in this presentation is, if you guys know Robert's story, when he lived in Hawaii and he was exiting out of the Marine Corps, he went to a real estate course and he paid $300 for it, which was 1 month of his salary. And the one huge takeaway that he took away from that course was that the instructor told him and all the students, you guys are going to have to get out there and look at 100 properties before you find one that actually makes sense, that you're actually going to buy. And that right there eliminated most of the class. As I'm sure you can imagine, that's a lot of work. But the reason I point that out is because that's the exact acquisition process that Ashcroft Capital uses. They don't use it because of Robert. It just happens to be the numbers. There's 100 deals out there on the market for sale or on market, off market combination. So you're going to run the numbers on them, and only 30 are going to check out where you say, yeah, okay, that deal might make sense. And then you're going to tour 10 of them, and you're going to go in depth with your property managers and the surveys and the whole due diligence process and submit some offers. And at the end of the day, you're lucky to get one. It's a huge numbers game. It is more than a full-time job to try to find these deals. Ashcroft at this point is finding about 40% of their properties quote unquote off market. And why I say that way is it's not off market in the way that most people might think, where it's just like knocking on someone's door, who owns this property? Hey, I'll make you an offer. And that was never for sale. It's more like broker relationships where they say, oh, Ashcroft might be interested in this, and they have a track record of closing, and they always bring the capital to the table. So we're not going to, waste our time here putting it out on the market for all these newbies getting started. We're just going to call 2 or 3 groups that we know can close the deal, and we're just going to, highest bidder gets it. And that's kind of how it works in this space. And so Ashcroft's fortunate to have deal flow in the markets that they invest in. Okay, just real quick, I'm going to go over property classes. I kind of went over this a little bit, but you've got Class A, Class B, Class C, Class D, and these are kind of the differences. When I say Class A, we're talking about new construction, the highest rents, the high-end amenities, affluent neighborhoods, expensive homes are nearby, maybe even a golf course. These are loose definitions. Everyone kind of has their own take on what a Class A, B, C, D is, but basically think of it that way. Class B is going to be more than 10 years old, well-maintained, a little bit of deferred maintenance, middle class, middle income, safe neighborhood overall. C's built in the last 30 years, usually a lot more deferred maintenance, show some aging, low to moderate income areas. I would say if you try to put that into numbers, these might be tenants making 30 to 50,000 a year household income. And then you've got Class D, more than 30 years old, usually no amenities, no pool, no gym, nothing like that. Needs some work. Sometimes they're in high crime areas, bad neighborhoods. And the point in me telling you all that is that B is just sort of the sweet spot. It's where I invest with all groups. Sometimes I've done a couple C's, never done a D, never done an A. And Ashcroft pretty much focuses exclusively on B-class multifamily. So I've talked a lot about, value add and adding value and renovations and all this kind of stuff. So here's kind of how the game works in the syndication space. Big difference between single family and multifamily. Multifamily, the value is derived from the net operating income. You can see that at the bottom of the page. Okay, it's going to be a multiple of whatever the net operating income is on the property. So when you buy a property, the name of the game is how do we get rents up and revenues up, and how do we cut expenses down? What was the previous management company doing that was inefficient? Maybe they were spending $100,000 a year on landscaping, and we have a connection to do it for 50. Things like that, right? And then as far as revenue, I mentioned some of that, on-site self-storage, and you can do, coin laundry facilities and premium parking and all kinds of stuff. So go more into that. I'm happy to share in a lot more detail about, specifics, but it's going to be deal by deal. It depends on what the property needs. But that's the name of the game, is increasing your net operating income. That's where your value is derived from. So here's just a real quick snapshot. It's probably hard to see on your screen. The pictures aren't great, but these are like just typical renovations that Ashcroft will do. You can see the kitchens there on the left, kind of bland, outdated, into, stainless, quartz, sometimes granite, depends on the area, backsplashes, white cabinets and refinishing, things like that, wood floors. They do the 2-inch faux blinds, LED lighting packages, all that kind of stuff. It's pretty much the same on all the properties. The goal is, as you can see there at the top, to seek a return on investment of no less than 25% when implementing property-wide renovations. So simple numbers there. If you were to put $10,000 renovation capital into one unit, you would expect to get at least $2,500 per year in increased rent or revenue by doing so. Usually it's not that high as far as renovations. It's about half of that. So $5,000 and $1,250. Here's just a closer up of the kitchens and some of the things that I just talked about, the backsplashes and the cabinets and stainless and granite. I actually got an opportunity to fly out to Dallas about 4 months ago. I went and walked 9 of the Ashcroft properties, just like sight unseen, I guess you could say. I just showed up. Nobody knew I was coming, and I would just, hey, just like to see how the renovations are going, and can I see a couple before and after units and blah, blah, blah. And I actually got to see that exact unit that you see in the photo there, and I can tell you they're replicating that process on all their properties, and it's amazing. They look phenomenal, and there's a lot of efficiencies by using the same contracting groups and things like that. So just a quick snapshot there. Okay, so let's talk a little bit about markets. Joe Fairless, as Daniel pointed out, if you guys know Joe, he's got the best ever real estate investing podcast. It's the longest daily running real estate podcast in the world. He does the best ever conferences. One's coming up here this month on the 20th to the 22nd in Keystone, Colorado. He's got the best ever apartment syndication book. So his brand is best ever, right? Anytime you see best ever, that's probably Joe Fairless's something. And so he is from Dallas-Fort Worth. And a lot of the properties that Ashcroft has done historically and to date have been in Dallas-Fort Worth, with the exception of a handful in Houston, a few in Ohio, and recently in the last 18 months, we invested in Florida, in Orlando, Jacksonville, and Tampa. But as you can see here, there's a lot more markets that they focus on. So if DFW quits making sense, they have plenty of room to expand out. not going to go into all the analytics here, but the things that they're looking for, just, rent growth projections, vacancy, population growth, where are people moving to, and diversification among employment, and, where are companies relocating, things like that. Case studies. I will go over this quick just in respect to your time, but I do want to point out a couple things. These are just 6 deals. I think it's 7 now. The slide's a little bit outdated, that they have taken what's called full cycle, which means all the way through. They've bought, they've renovated, executed the business plan, and sold. And so you can see on the far left the unit count. Ashcroft typically is operating, for the most part, 200 units to 600 units. Incrementally, they've been getting bigger and bigger as time has gone on, so you're not seeing all of that here on this slide. And then, as we talked about, 1980s, 1990s, there was one here in the 70s that was like a C-class property. And as you move over to the right and you see IRR, that stands for internal rate of return. IRR is basically, in layman's terms, it's a very sophisticated calculation, but it's if you take your cash flow that you've been receiving on the lifespan of the project, and then you add all the equity or the capital gains that you got upon the sale on the back end, and you merge those two numbers together, and then you kind of divide up over the lifespan that you held the project, that would be kind of like an annualized return. So as you see of the first example, the Elara, 22.3. That's so investors, had they invested in that project, they bought in March 2016, they sold October 2018, so a little over 2-year hold. They would have made about 22.3% each year. So was that 45, almost 50% basically is profit over a couple of years. So loosely, that's kind of how you can figure that out. The point is, what stands out to me on here, and the thing that I appreciate so much about Ashcroft, is how conservative they are. None of those projections that you see on the right were projected in the pro forma or in the overview of the deal. They typically will project like 7 to 10% annualized cash flow and maybe 14 to 20% IRR, internal rate of return. Basically, all this shows you is that they've outperformed their projections, aka they've been very conservative. So that's my takeaway from it. As I said, there's another deal that did exceptionally well that's not on here, but I'll update that slide. All right, here's a couple real examples. B-class property, built in the year 2000, Houston, Texas, 250 units. So what happened? They renovated the units for about $5,000 each. They were able to raise market rents, approximately $75 per unit. They added washers and dryers where previously they didn't have them, more or less. So what happened? Well, that all happened in a very short time frame. So Ashcroft did a refinance instead of a sale, and they were able to return over 50% of the funds that the investors initially put in within a 16-month time frame. So had you put in $100,000, you would have got approximately $50,000 back in a year and a half, and then continued to hold the asset. All right, sorry about that, guys. I'm gonna try to make up for some lost time here. So go over a couple more examples really quick. I'm just gonna skip over some of this. Another B-class property built in the 80s, Richardson, Texas, 220 units. Basically, this hold period was 29 months, so a little over 2.5 years, where we're expecting to get them. At that point, we're just really looking for a buyer. Sometimes a refinance makes more sense if we want to hold a little longer for any reason, but at the end of the day, it's like, if we're going to hit or exceed our numbers, we're just going to take that option. So you're kind of at the discretion of the general partnership. When you invest in a syndication, so that'd be Joe Fairless and Frank Rossler at Ashcroft, to kind of make these executive decisions on what's in the best interest of the passive investors. All right, real quick on accreditation. Ashcroft is one group in the space that only works with accredited investors. don't worry if you don't meet this criteria. There's plenty of other companies happy to speak with any of you about that work with non-accredited investors who are deemed sophisticated investors, meaning you can just understand the deal and the risks and the ins and the outs and what it is you're investing in and the fact that it's illiquid. And as long as that's appropriate for you, you're deemed a sophisticated investor, you could participate. But as far as Ashcroft and accreditation goes, you have to have a $1 million net worth excluding your primary residence. That can be individual or by couple. And as far as income goes, you can also qualify by income, $200,000 per year as an individual for the last couple of years, with the expectations of meeting the same income in the current year of 2020. And if you're a married couple, $300,000 income for the last 2 years, with the expectations of hitting the same in the current year. That is what accreditation means. If you meet that criteria, you are eligible to participate in some of the deals that we were just talking about, or upcoming deals rather. All right, so what to expect when you invest? Pretty simple at Ashcroft. Monthly updates by the 14th of every single month, and distributions are sent out by the end of the month every month. Usually they start about 30 to 60 days after closing. Monthly there you go, 60 days after closing, sometimes sooner. 12-month performance evaluation. What they do is every 12 months, they will take a look at the income that was actually generated off the property, and they will disperse any additional collected rent above and beyond what they projected. So if they set out to say, hey, it's going to produce 8% a year, at the 12-month mark after closing, it was actually 9%, you get a 1% bump distributed all at once, plus your regular 8% annualized distribution. K1 tax forms we talked about, delivered by March 31st. They do not extend, which means you do not need to extend or amend your tax return, which is fantastic, because I do work with groups that do that, and it makes me angry. Anytime you'd like to review any property financials, status update call, happy to accommodate. You can speak directly to Joe Fairless, directly with Frank Rossler, directly with me, anybody on the team. Happy to, get you whatever you need. By the way, it's not on the slide, but quarterly financials, like the actuals from the property managers, exported from like a Yardi service as an Excel file, are quarterly. So you get monthly updates on how the occupancy is doing and where we're at in the business plan, and then quarterly are all the detailed financials. I like to kind of end on this note. It's more than money. I know I ran fast and we talked a lot about numbers and analytical stuff, but at the end of the day, you guys, it's some people just want to volunteer more with their time. Some people want to travel more. Some people just want to spend more time with family and be a little more hands-off, not so active in real estate. Some people just want to sit on a rock and look at the sunset, I guess. And some people are just looking to retire, whether that's retire early or just retire. And, so really it's about what this can do for your time freedom and, what you're going to do with the income, the passive income. So thank you guys again. Sorry for the my screen cutting out there in the middle. Do you know anyone I could help? Maybe it's you, maybe it's a friend, maybe it's a family member, whatever. Here's my info, Director of Investor Relations. There's my direct phone number. That is my cell. That is my email. You can also find me on Bigger Pockets, LinkedIn, Facebook, the whole works. I'm out there. And and by the way, Passive Investor Guide. So this is a free download. If you guys want to take part in this, I highly recommend it, because I did not get to cover a lot of very important topics in this conversation, like how to vet sponsors, how to vet markets, how to vet a deal, common terminology, all kinds of stuff. So you can just have a free resource guide when it comes to multifamily investing. Ashcroftcapital.com/passive investor. And from there, I guess we can open it up for Q&A. I think we still have time. I lost track of my time.
We definitely have time for questions. We've got 10 more minutes.
Ah, sweet. Let's go.
Travis, is there any minimum amount that we should come up with to invest?
That is an excellent question. Every company is going to have a minimum investment. Ashcroft's is $50,000 for a first-time investor, and then they reduce that to $25,000 for returning investors, so that you can diversify and take part in as many projects as you'd like. Another thing I didn't point out is they do not do funds. So it's not something where it's like a blind pool. You give them money and they say, we're going to buy who knows what and stick it in this big fund and then hopefully you like it. It's one property at a time as they go. So typically every 2 to 3 months, I would say they have a new opportunity on average. Good question.
What's the typical, I mean, the examples you showed us, they sold within like 2 years of the purchase. Is that typical or are any of them longer?
Yep, excellent question. The question is, a lot, as you could have seen there in the slides, they sold at the 2 or 3 year mark. Is that typical? Yes and no. I'd say more so around the 3 to 4 year mark is kind of the typical range. They underwrite for 5, again, just to be conservative. They hope to sell at 2. They hope to sell at 1. I mean, they hope to sell the next day after they close. But, if first of all, we have to hit the projections. And once we can at least hit them and hopefully exceed them, we're just going to take that offer. And usually these value add plans will take, 12 months, 24 months, 36 months on a big project. And then we're just looking for a buyer at that point to make a sale.
So what happens if it's down market and you cannot meet the target for a long time?
I'm sorry, can you repeat the question one more time?
No, what happens if it's down market and you cannot meet the target for a long time?
If we have a housing crash or something like that,
yeah.
I think, and you can't sell, what do we do?
I'm sorry. It's probably my headphones here. Let me put in, hold on one second. Sorry about that. Put in both here. All right.
So
go
Travis,
ahead.
the question was, what happens if there's a down market and you can't give the investors their money back for a long time?
Gotcha. Okay, great question. Yeah, so here's kind of the way that I look at it just as a passive investor. First of all, the reason I like the B and C class is because you're kind of walking in from day one with a margin. You're usually finding them off market. You're usually buying at a slight discount. So you already have kind of a built-in. Imagine buying like a used car that needs some work, right? So you're going to get that car at a discount. Now you're going to fix it up, make it run again. Now it's worth more money, okay? And then in terms, to switch back to multifamily now, everything is stabilized and cash flowing. So if you look back at 2008, 9, 10, and in the multifamily sector in the B and C class space, what you would find, I'm just giving just a general blanket example, you might find something like, well, the occupancy went from 95% before the recession to 88% in the great real estate recession. But guess what? The break-even point in most cases is more like 65% occupancy. So it's a very conservative play. So again, adequate cash reserves, the right kind of debt structure, as we talked about earlier, where if you're in the middle of a recession, you're not forced. If for any reason there's not enough equity just to exit, or you don't want to exit, you at least have like a 5-year, sometimes 6 or 7 year buffer to figure that out or to write it out. But so that's all to paint the picture of these are illiquid for at least the business plan that they're projecting, which would be 5 years, with the caveat that, yes, in the worst case scenario, maybe we have to hold on to it a little bit longer to get the equity to come back. And so that 5-year plan could end up being a 7-year plan, or it could end up being an 8-year plan. So it's all about the team. It's all about the structure and the track record and all that kind of stuff. But basically, in the multifamily syndication space, in my opinion, it's the safest play to make. A lot different than a new development or, something like that, whatever, student housing or something where the school goes out and then, your real estate takes a huge dive in occupancy. So hopefully that kind of answers that.
So normally the properties that are acquired, they're going to be sold within the average how many years? Could be 5, you're saying? Depend?
Right. So they underwrite for 5, so it's kind of the expectation. But in all reality, they typically will sell before the 5-year mark.
Okay. And then the other question is, let's say you mentioned that the minimum amount to invest is $50,000. How do you know what percent that when you invest you will actually make or not make? Depending on the market, but what's the sort of
Yep.
standard average, that you could?
Yeah, good question. Something I look for just personally as an investor in this space is a preferred return. A preferred return means the limited partners are going to get X amount of percentage. Like the first, to use an example, 8% preferred return means the first 8% that the property produces goes 100% to the limited partners with no fees or splits or commissions or anything like that. Then whatever's after and above 8, that's where the general partnership can start to figure out a fee structure or to, start taking kind of their cut. So it puts the best interest in favor of the limited partners, and it provides you not a guarantee, but as close as you're going to find to a guarantee of what to expect as far as cash flow goes. You're going to see that on the deal pro forma or the overview of each project. It's going to say year 1, we think 8%, year 2, we think 8.5%, year 3, we think 9.5%, that kind of thing. As we're incrementally raising rents and raising revenues, we're going to be able to distribute more, and so the cash flow is going to be going up. So you're going to get like a ballpark projection up front and kind of know what's likely to happen. Again, knowing they're being conservative.
Right. So it could be on the average saying 8%, but it varies depending on the market and the rent increase and so forth.
Right. And I mean, yes and no. I think a little less on the market per se, as we kind of talked about, like in an extreme example of a huge recession. I still think, Ashcroft's deals could meet the preferred returns. Mm-hmm. So I wouldn't put too much emphasis on the market per se, but really it's going to be about the execution of the business plan. Is the team competent, and are they actually able to do what they say they're going to do? And the good thing about B class is you're typically not doing huge value adds where you're like gutting the units and going down to the studs and just starting all over. You're just slapping some paint on there and redoing the kitchens, and you're making them look better, overall, and enhancing them, but not. I mean, anybody could really pull that business plan off. You just have to, do it. You know what I mean? It's not that heavy of a lift.
Okay, and then another question is, if the case you invest 50 and then do you have to wait until that property is sold before you get out of it, or can you back out in terms of the contract? Is there a penalty, etc.?
Good question. So it's a lot different than like stock market stuff. So it is illiquid for the business plan time frame, again, with the caveat that it could even go longer than that. So just think of it that way in the back of your mind. If you put 50K in, I wouldn't expect getting 50K back for 5 years. That would just kind of be my mental note. However, some people, they run into life situations, right? And a year in, it's, oh my gosh, I got these things I got to pay for and I need that money. You can either facilitate finding someone to buy out your position, and you kind of negotiate that on your own terms, or Ashcroft's really good about accommodating. It's not like a standard practice, but they do it to where they'll buy out your position, or they'll find somebody who's already an investor in the project to buy your position out. But you should never rely on that. That's not a guarantee. That's just something that they try to accommodate to, because things happen.
So it's more a special circumstance that they try to accommodate, right? Otherwise,
exactly. You're right. They want to do right by the investors, of course. At the end of the day, they're not going to be black and white on it. But just I wouldn't count on it. Just it's illiquid. So.
Yep. Thanks.
Yep.
So what does the cap rate look like for your properties?
Yeah, good question. Depends on the market. Dallas-Fort Worth, I don't know how many of you are familiar with that market, but it's highly competitive. Cap rates are, they've been ranging, I would say, anywhere from 5 to 6 caps is kind of where we're at in that particular market. As you branch out to, Ohio or some other market like that, Indiana or something, you might find, 6 to 7 caps, something like that. And then just to give some perspective, if you're looking at coastal areas, which we don't invest in, or a Manhattan, San Fran, you might find like 2 caps or something like that. It gets really intense. So we're in the 5 range right now. Yeah. And to explain that to everybody, if you don't know what a cap rate is, think of it, here's the simplest way to think of it. If you were to buy one of these properties, all cash, no debt, no loan, all cash, then that would be basically your return on investment annualized. Okay, so like maybe a pension fund is going to buy a 300 unit apartment complex at a 5 cap. They're basically going to be getting 5% a year off the cash flow.
All right, we're out of time. Thank you very much, Travis, for coming and sharing with us.
You bet. Thank you, Daniel. Thank you, everybody. Great questions, and definitely reach out. Travis at Ashcroft Capital. Happy to answer. Hop on a call, whatever you guys need. And again, I mean, I work a lot with Ashcroft, but if you guys want to talk about, non-accredited groups or any other groups out there or any other type of passive investing, I help people on a lot of different scales. I do it for free. It's not a consulting or a paid gig. So feel free to reach out.
Thank you very much.
Thank you.
Also, if you really enjoyed this, I'm trying to get our attendance numbers up a little higher so that we can have the quality guests like Travis. So if you really enjoyed this, please feel free to share it with a friend or somebody who might be interested. That way we can really attract those top quality speakers. So thank you very much, and we'll see you all next week.
Thanks.
Bye-bye.
Thank you. Bye.
Thanks, Daniel.
Yeah, bye.